Hey traders, Jeff, Full Throttle Traders here. Are you getting volatility shaken out here? Don't watch volatility, trade it. Stay tuned for the update. Okay, traders, let's talk a little bit about the last couple of days and how we see the market, how we can potentially participate in the market. One thing's different is volatility, right? And we have to realize kind of where we are in the grand scheme of things and be able to trade accordingly. So the ways that you were trading before may have to shift a little bit here, as I was telling some of our members of today in the Full Throttle Traders, what sometimes maybe the add-in approach is better. So let's say that you have, for example, normally a $5 stop on Microsoft or maybe PayPal or NVIDIA or something like that. You want to extend that stop out quite a bit in here, and you want to leverage in. Typically, I do it in threes. So if you typically, let's say you're looking at 1,000 shares, you're coming about 350 shares, give it a wide stop, right? Allow yourself to add back the position and increase. I'll go through an example here in a second. But before I do that, I want to take a second here and review the overall conditions of the SPY. So here's the SPY here. If I look at the Qs here, you can kind of see the difference in here. This was definitely not as bad. The SMH did make a pretty good comeback, at least the early part of the day. And XLK was the major tech was right in there as well. But let's take a look at the SPY just so you can kind of understand this. The drop here was pretty profuse. Now, one thing that I've noticed over the years is that not only when you're trading in trends, you have to look at extensions. So we have a large gap extension here from the trend line. This is an official primary trend line of the S&P 500. And you obviously saw with the gap down off the initial part of the tariff news, the announcement on last week, and then the continuation, and then yet the continuation on Monday, and then today. What happens is it builds a gap inside the trend line. So these gaps are almost like extension lines, and market doesn't typically like to be down that far from a gap. So it tries its best to fill the gap. Now, remember, news at first will outrun that. So sometimes that news will drop in here because it's facts, it's immediate, and it doesn't conspire to maybe new bids that are coming in. But the market ultimately wants to try to fill that gap in there, wants to fill that area as much as it possibly can. But again, until we lighten up on some of the news and some of the tariff news there, which could take anywhere a total of 5 to 7 days. I typically see that when I'm looking at FOMC in the news, the announcements, the spikes, the volatility. Typically, it's a 5 to 7 day shakeout, sometimes more, sometimes less. But today, in this aspect, I would say it'd be at least 5 to 7 days. But once this gap starts to go, you're going to see the market take off towards the center part of this gap from the trend line to where price is down here to try to basically combat that. The market doesn't like gaps, but it also doesn't like the fact that you're actually far, far, far extended from averages, moving averages. A lot of the algorithms will kick in and bring the market back into somewhere in that area. And where, I don't know. How long it takes, 5 to 7 days or longer. We could be sitting here sideways. The longer we sit here sideways and the more the gap trend line keeps coming down, that will narrow it in itself. But if it happens in the next 2 to 3 days, let's say by the end of the week, you're going to see a rampant move back up just to kind of shun some of that gap from that trend line being so far extended in there. It's just what fear and greed does to the markets. It doesn't to anything, but specifically in the markets here. So let's take a look at where we actually have come. We've come down here in a most of our original trend line as we had a higher low, came back up, and this was the area go or go home. It was around 38% of the move here. And I remember my last video, I drew a box there. I said, look, this is go higher or go lower. And obviously it went lower. But you can see down in here, we also have a little bit of a measured move, I should talk about here. So we want to consider these areas as, again, just going in for a lot lighter, expecting volatility until it isn't, and allowing the market to kind of shake around. And you do that using an add and reduce model. So if I'm at a $100 stock and I want to normally give it a $5 maybe or $10, I might want to give it 20 or 30. I don't expect it to go to 70 or 60, at least now. But if it goes in at a third and pulls back, this is the only time that I'm looking to add on a pullback. So if I'm adding back a third here at 90, I can move my stop up to make sure my stop stays in place. And the reason we have to do that is because if you give it that wide stop on ultimate shares, you're locked in at that $100 price and you have a huge swing in there and you have to kind of deal with that pressure. This is how you begin to find a better neutral place by adding in, but ultimately making sure you move your stop up so you're never out of balance on your risk. A lot of traders fail here because they actually start adding and adding and adding and maintaining their stop or even lowering their stop, and they get out of balance on what their risk is. Remember, you must stay with a plan in here. That plan could be done a few different ways, but you have to have a plan to mitigate risk, ideally. So that would be number one. Number two, you're also looking at a measured move here. A measured move basically looks at the market and says, okay, how far have we been down here? When you have these markets that are just docile, they just move crazily. There's not a support area like a normal move higher or lower. You have to mark off these highs and lows where it kind of went to and then the low here. And this would be considered more of a measured move. So when I look at the bottom here, or the middle price of this measured move, somewhere around 562, if you do the math to 612, and you do the math right down here to about 495, it actually is the center point. Basically, let's call it the pivot line here around $500, give or take. So when the stocks move down, it doesn't have a basis on where support is. It'll go into a measured move, and this is what traders do. It's institutional traders. They will mark it off on their charts, and the distance that it moved from the top to the center, if it breaks down again, they've pretty much marked off where that bottom point is. It's not about support. It's not about resistance. It's about the distance of the moves become equal within region, within range, okay? And that mark off would be right about in here at about this, let's call it the 500, 503 point area. That's kind of where we're starting to kind of get some docile activity, maybe trying to rebound here on volume, as you can see. So keep that in mind. When you don't have real legitimate support areas, think about the moves, watch the sideways or the rehaps, and then the move. If it does move back down again, draw your lines, take the number of, in this case, 613 to 560, and mark that off again. Draw your line there, and you're going to find more often than not, that is an area of contention. So I think we're entering that stage right now. And not only that, $500 is a psychological level. So traders, at least non-retail traders, are not looking for 501.60 to get in or get out. They're saying exit me at 500, exit me at 490, exit me at 480. These are big. They round those numbers off because they're dealing with, $8 trillion of money we've lost here in the markets in the last 2 weeks here. And they don't go down to the penny like retail traders. They actually mark it off by 10s or 20s and whatnot. So we're at that area. It could be critical stage here. But again, I expect my market bias to be the market is going to find its way back up here to some degree, maybe $20 to $40 move. Sometime either latter this week or maybe in the early week to come. That would be kind of where my adjustment will be, somewhere in here. Now, if it stays in here a lot longer, I'm going to shorten that span because it's not going to necessarily touch the trend line. We're just going to go back up and find that home in here. Remember, market does not like this wide, disparate move between the trend and price. It wants to uncover that. Now, sometimes it will uncover it by going sideways and getting it closer, and then a smaller bounce. If it happens now, we're going to see a much bigger bounce just in retraction to that trend line area. So wait and see what happens. This is Jeff Yates at Full Throttle Traders. I hope you enjoyed this. Click on the subscribe, like it, get these every few days to kind of give you an update on where the market is and more importantly, where it's going.